Good afternoon to everyone, and welcome to our first session for FAC3702. Okay? My name is Olan Oliphant, and I am your tutor for this module, or I've been the tutor for this module for the past 3 to 4 years. So I think just a couple of rules is the fact that we will not going to be able to interact with one another via voice because there might be too much of us on here. So any questions perhaps that we have, we need to perhaps put it on the chart. So on your screen, if you toggle around let's say the cursor, you will see that there is a chat icon on there. If you click on there, you should then be able to see the chat on your right hand side. Okay. Also, in terms of if you have issues accessing the link or the material that have been loaded for you, there is information that has been provided for on the chat box by Bronwyn Wright. Okay, so if you can do for me a favor, if you present, just indicate to me by means of your student number on the chat box, and then any other technical related queries should then be addressed to the CTN-TAT email address, and Claudine is going to put, Claudine or Evra is going to put that up for us, what that email address is going to be. So it's ctntat@unisa.ac.za, but they're going to confirm with us just now. Okay. So the fact of the matter is now it's not business as usual. Things have changed. So that has also then pushed us to also change in terms of how we deliver tutorials. You know, so now we went through the online platform, which is, I think, it's a very good a way or exercise to go, because you can sit at the comfort of your home or wherever you are, and then listen to or participate in the class. But also the fact that after the session, I think maybe later today or tomorrow, a copy of the session, the recorded copy, will be made available. So you can access that through Teams or through the UNISA link. And you don't require any data to actually access that. So the only data that you require is, I think it's about 1 meg just to get onto the site. Thereafter, everything, I think it's free, right? So yeah, okay. So we're going to start now, but I think I just need to clarify to you that I am not doing any teaching here, but I am assisting here you on, let's say, on a specific matter. So this is a tutorial, so it's a two-way street. We engage each other, whether it's through we engage each other through the chat box, you know, so those who have been in the FAC 3701 would by now know as to how things work. Okay, so as might as I have the question here, but I will not I'm not going to be covering all the specifics thereof. I'll touch there and there, you know. So yeah, that's how this session is composed, because I aim to assist you on specific areas that I know, or perhaps you are struggling on, but it's not to cover the full content. So therefore, the reason why I upload material on Teams is for you to adequately prepare, so that you can gauge yourself or your attempts against to what I have on here. Okay, so we're going to start now. Yeah. So what I'll do is I'll share my screen with you, and okay, just share screen, share screen, desktop window. So share. Okay, so in front of you, you should. Okay, what's going on? Okay. Okay, so in front of you, you should be seeing a question that says question 1. If you can see that, just say yes or thumbs up, whatever. It is, so copies of these material were provided or is available on the link, the same link that was posted on here earlier. Okay, great stuff. You guys can see that. Okay, fine. Now, the idea is, let's assume now you're sitting in an exam room, like dishing out you this question paper. Fine. So obviously, the first part that I would do, so I'm going to teach you the easier way, but there's nothing also that stops you from developing your own way that is easy and you're comfortable with. Because how I structure this, I want you to be able to accumulate the maximum marks within the stipulated time required of you. You know, so all the easy marks you get them first, and then thereafter you work with the complex stuff. But if you have all the principles, there's nothing that stops you from actually getting higher marks for that specific question. Okay. So the first point of departure would be you read the question. Now you're reading the question sort of, I'm now reading a newspaper. You're not reading to make notes and all those kind of things. You just want to understand what's happening within the question itself, right? Fine. Now let's assume that you, in your pre-reading before the start of the session, you've already read this question and then understood what's going on and all those kind of things, right? But now what's important for me is it's in terms of in that time when you are reading to understand, what's important for me is in terms of the required, right? Make sure that you understand what the required is saying. Make sure that you are addressing what the required is saying, right? So don't do all other unnecessary stuff that is not required with what the required is saying. Okay. Now you will see a required A or required what it says you need to prepare journal entries of the cash transaction included. So prepare all the relevant journal entries, cash transactions included in the accounting records of Choco Coffee Limited to correctly account for the roasting machine. That's very important. They are only asking you to do the journal entries only to account for roasting machine. We know there's roasting machine, there is plant and equipment, there is building and all those kind of things. But this question specifically, it speaks about roasting machine. And even the mark allocation should also guide you as to, they're only speaking about one item here and not all the PPE items. That's very important. But what they also say here, they say these journal entries must only relate to those following dates. We already know now what happened to those following days, because when you're reading the newspaper, we actually have an idea as to what it is that happened. Fine? Okay, right. But as additional, they're saying that you need to ignore tax implications. No journal entry for depreciation is required. That's important. Do not do a journal entry for depreciation because it is not required, right? No abbreviations for general ledger can be used, and then narrations are not required. You need to show the date for each entry. All calculations must be shown. I'm going to explain to you why all calculations needs to be shown, okay? And then round off to the nearest rand, okay, blah, 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 that you understand, fine. But now going to number two is saying use the information in the above journals as well as other information that is disclosed, as well as other information within the rest of the question. And then now you disclose the roasting machine as well as the other PPE, okay? And then they tell you now it needs to be for the 31st of December, 2011. And then that's in terms of IAS 16. Okay, right? Now, we already know what the year end is. We know that it's the 31st December 2011 that we're dealing with, right? Okay, so that's very important because you don't want to go back to the question again and trying to find out what that year end is. You know out of your head now that it's 31st December 2011. But it says note, accounting policies accounting policy notes are not required. That will always be the case because we don't require, I don't think at this level of the module we require students to do accounting policy, right? And then you need to ignore comparative information. I'm going to show you now what comparative information is. Show all calculations and then that and that and that and that and that. Now, number 3 is specific. It says you need to calculate. It's not a note. You need to do a calculation of the deferred tax balance in the statement of financial position. It's not a deferred tax movement. It's a deferred tax balance. There is a difference between what a deferred tax balance is, and there is a difference as to what a deferred tax movement is. Okay, I'm going to show you now in the question as to what that difference is. And they specifically highlighted to you, showing you that you need to use the statement of financial position approach. Okay, so for this module, that's the only approach I think that is recommended, or that's being used, but it's not the only one. Okay, and I think that's where then the required ends. Okay. For question, we're only doing question 1 for today. Right. Okay. So are we still all together? Is there any questions that anyone wants to ask? Just drop it on the chat, and I'm going to answer it while I'm busy with something else. Okay. Now, my advice is, once you have read the required part, okay, so this is the following step that you need to do. Fine. Now, you have so they have told you that you need to do journal entries. Okay, there is my skeleton for journal entries. I've drawn my skeleton for journal entries, and then they've also told me that I need to do a PPE note for roasting machine, and as well as the other PPE in terms of IAS 16. Okay. Fine, and then the other part as well is, I know they've told me that I need to do a deferred tax calculation, but they're only wanting this for 31st of December 2011. However, within the solution itself, I've done a complete one just to illustrate to you as to what is the difference between a deferred tax balance as well as the deferred tax movement. Okay, fine. Now we're going to start with the journal entries. Okay, so we all know that the journal entries only relates to the roasting machine, and not the rest of the rest of the questions, because they've specifically told us that you only do journal entries for the roasting machine. Right. Now we go to our question. I'm showing the wrong one now. It's this one. Okay. Okay. So Chocolate Coffee Limited is a company situated in KZN. The company has a 31st December year end. We know that already. So on the 1st of November 2010, you bought or you placed an order for coffee bean machine from an Italian company for 3,000 euros. So the invoice amount is payable by the 30th of June.
Something natural. No, they're all natural. You know, they start natural, and then you just want to heighten them up and put on.
I think I've tried to mute everyone, but I'm not sure why. Okay, so sorry guys about that. Okay, so the order was shipped free on board on 1st of December 2010. Okay, now in your books from the 1st of November, what it is that should be happening? Is there something that we're going to recognize or not? In the chat box. So what's happening in the 1st of November 2010 in your books? Should we record something or should we not record something? No, there is nothing that we need to record, Judy and Annelene. That's correct. Because at that point in time, we've only placed an order, right? And now, when this item was shipped on the 1st of December 2010, what it is that we need to do, we need to record an asset. right? We don't know for how much it is now because it's just analyzing the question. And they are telling us that this machine was available for use on the 1st of January 2011 and was also brought into use on the same day. So if you read these two statements, where does these two impact you? Is it when you need to calculate your depreciation or when you need to calculate your tax allowances? It's both your depreciation and your tax allowances. Because as much as the machinery was shipped on the 1st of December, but you're only able to make that use of that machine only on the 1st of January 2011. You know, because obviously on the 1st of December it was still on its way to you, and then on the 1st of January it was available for use and was brought into use. Brought into use is a very important concept for tax purposes when you're doing your deferred tax calculation or when you're calculating your tax allowances. The useful life of the machinery is 10 years with a residual value of 5,000 rand. Okay, and then now they're giving us the rates here. Following the following dates and exchange rates are applicable to the transaction. The 1st of November, we know that's when we place the order. The 1st of December, we know that that's when it was shipped. So we need to recognize an asset and recognize a liability, which is going to be our creditor in this regard. 31st of December, we know that was the year end. So we need to now apply the requirements of IAS 21 when you're doing the translation, okay? And then 30th of June, we know that was the date that the liability was settled. Okay, now they're saying spot rate is, so for €1, you require so much. Now, is the rand stronger or weaker in this case? The rand is weaker because you require more rands in order to buy one or in order to have €1. So your rand is weaker. Okay, so the interpretation of this question would have gone this way. It's always important that you need to draw yourself a timeline. Because you remember the idea, once you have read the scenario or the question, I do not want you to go back again to the question. You are done with that scenario. You need to move on. So out of that scenario, I would have then summarized my scenario in this way. So this is my scenario. It's a summary of my scenario from words into numbers. So my whole scenario that I've read here, so my whole scenario that is here, I have now transposed it into this little thing that's here. So give me now the whole picture. Now I can complete my journal entries without even having to go back to what the scenario is saying, you know, because everything is here. So I know this was the order date. I know this is when the equipment was shipped. See, the equipment was shipped here. I know here, 31st of December is my year end. Now I need to do translation. I know this is where the debt was settled. Okay. So remember we said on the 1st of November 2010, there is no entry that needs to happen. Okay. And then I think we're still all in the same part. There is no entry. But something happened on the 1st of December that this machine was now shipped to us. And then in terms of the agreement, that is then when we will take, in terms of the FOB principles, that is then when you will then taken the risk and rewards for that specific thing. Once it's either loaded on the ship or whatever mode of transport it is. Okay, now we need to record, we know that our assets are going to increase with the roasting machine, and then also our liability is going to increase because we have not yet paid that liability. We'll only settle the liability when? 31st of June 2011. Okay, now what's important, and I think what students miss most of the time, is the fact that students do not indicate which statement is impacted on each specific transaction, right? So you need to be able to indicate as to which statement is affected. Is it your SFP, which is your statement of financial position, or is it your P&L, which is your statement of profit or loss, or is it OCR or other comprehensive income, or statement of changes in equity? So you need to be able to indicate that within your solution, because to me, if you don't, that is not a complete journal, or it's not even a journal at all. I wouldn't recognize it. Understand? So you need to be able to indicate that, because remember, the idea of the course, it does not end only with the course. You need to go into practice, and then in practice you need to disclose these things appropriately. You know. Okay. So we would have debited the machine with 30,090, and then as well as would have raised a liability or creditor with 30,090. Now, how do we get the 30,090? We said, okay, we have a spot rate of 10 rand 3 cents on the 1st of December. We know that the item costed us how many? 3,000 euros. So 3,000 multiplied by 10 rand 3 cents, then it gives you 30,090 rand. Fine. Now the next step is we have reached our year end and we have not yet settled the debt, right? And according to the rules of IAS 21, we need to do now a translation, because remember, we now recorded this transaction at 10 rand 3 cents, but we have not yet paid this transaction at year end. So now if we have to pay at year end, we will perhaps have to pay 10 rand 36 cents. So are we now incurring a foreign exchange loss, or are we now incurring a foreign exchange gain? Because now at year end, it cost you 10.36 cents, but initially, if you have paid for this item on the 1st of December, it will have cost you less. So now it is, Bacon and Aline, yes, it is a loss that you've recorded. So there is our Forex loss, but now our Forex loss, to which statement does it go to? Does it go to our statement of profit or loss, or does it go to our statement of financial position, or does it go to OCI? Yes, it goes to our statement of profit or loss. So the indication of the journal here, it would have been profit or loss. And then what happens to the creditor? That would then be in which statement? In your SFP. Okay. Because for every item you realize in your income statement, it would have perhaps gone in any other statement. And then in this case would have been your balance sheet or your statement of financial position. Okay. Now, so that is the idea, or that is the exercise that one you would have to go through. Fine. Let's jump the 31st of December. Sorry, let's jump the 30th of June, right? And then now go to the 30th of, okay, so let's go to the 30th of June now, 2011. So what happened there is we've settled the debt. Fine. So there's two things that needs to happen in there. Is the fact that now when we settle the debt, we're going to settle this debt at how much? At 10 rand 29 cents. So if you're looking from the 31st of December up until 30th of June, would we incurred a loss or a gain? It would have been a gain. That's correct. Now, so meaning that we will now, so at what amount are we going to settle this liability? So what is the amount that what is the rate that you are going to settle this liability? We are going to settle it at 10 rand 29 cents per acre. That's correct. Okay. So now your journal entry in 30th of June 2011, there would have been two. The first one, you would have had to account for the Forex gain. And then the second part is you would have to account for your settlement of the creditor. Now the creditor would have been settled cash, I assume, not I assume, that is the case. So what is the account that would have been either credited or debited? So the easier way is I am saying that I would have credited bank, that's correct, Annalene, and I would have debited my creditors account because the creditors, the liability has now reduced. Creditor, okay? Now in which statement? In your SFP and in your SFP. There we go, Pharma. That's correct. And then the amount now will be obviously will be your 10 rand 29 cent times the 30 times the 3,000 euros. That would have been the amount that you've settled that liability at. Okay, we're down with journals now. You see how easy it is. Did we go back to the scenario? We didn't. That's the whole aim of in terms of you analyze that scenario, planning your response is that you don't want to go back to the scenario again. Right? So I want you to take a similar approach. Fine. Now we knew what was our second required. Our second required was saying we need to do the PPE note. Is there something that's stopping us from doing the PPE note? Because within that required, they are telling us that in the PPE note, we also need to incorporate roasting machine. So can we include roasting machine in our PPE note currently? Yes, we can, because we've got all the information. Perhaps the only information that we do not have as yet, which is we need to go and calculate, is going to be our depreciation for the 2011 financial year. I'm assuming we have to go and calculate that. But now, just by working only with the roasting machine, we're going to go to the PPE note. We're going to go to the deferred tax calculation note, address PPE, and address the roasting machine. Then we know we're done with the roasting machine. Then we move on with life. We go now to the other PPE note. Okay. You see now, already here, you've already got yourself, let's say 9 months in here. Right, fine. Now, using the same information that you've already calculated, we're now going to go to roasting machine. Fine. Now, so when was roasting machine bought? Okay, so I will assume that in the exam you draw this template even before you even start attempting a question. So roasting machine was bought on the 31st of December 2010. Right? So what would have been the cost that we need to recognize for roasting machine on the 31st of December? It's going to be 30,090 if I remember the amount correctly. It's going to be 30,000 and it can't be the settled amount because remember the settled amount you've paid only on the 31st of June 2011. So but you bought the machine initially for 30th for 30,090 rand. Okay, so the amount that is set, the settled amount, it only impacts your creditors because that's what you'll pay your creditor. But you would have bought the machine for 30,000 at that because that's what the exchange rate would have been at that point in time. So we're working with an accrual accounting system. Okay, but now what is the depreciation in the 31st of December 2010? So what is the depreciation for the 31st of December 2010? Yes, dear, is 0. Why is it 0? Because the machine was only available for use on the 1st of January 2011. So you would not have recognized depreciation in that regard. Okay. So Baker, it was not available for use for accounting purposes and not brought into use for tax purposes. So you would not have recognized either a tax allowance or depreciation. Then it's 0. Okay. Now we move on. So in the current year, we know what the cost is, right? The cost is 30,090 rand. Fine. Now, can we calculate the depreciation? Yes, we can. So the depreciation amount is going to be 2,509 rand, right? With a useful life of, I think it's 10 years. Sorry, I'm opening the wrong one now. So with a useful life of 10 years, with a residual amount of 5,000 rand. Okay, so your depreciation is going to be 2,509 rand. And then therefore your carrying amount at the end of December 2011 is going to be 27,589. Okay, and then in terms of your, there's a recon that you need to do. Okay, so in terms of this recon, whatever that you get into this recon here, you need to be, it needs to reconcile with this. So you will see within the solution itself, I've done a check to ensure that it always reconciles. Okay, so now we've done, so now we'll never go back to roasting machine as far as the disclosure note is concerned. Now, what was the other requirement? The other requirement was in terms of the deferred tax calculation, right? The deferred tax calculation for roasting machine. Just gonna do this quickly. So now we're gonna do the deferred tax calculation for roasting machine. So we already have the information. We already know that in December 2010, in December 2010, this was then, we assume it's you can either say 0 or you can either put 30,090 for both accounting and for tax, but the end result is going to be 0 because there wouldn't have been a depreciation or an allowance that you would have charged. But what's important here is the fact that in terms of 2011, your carrying amount would have been 27,589. Where do you get that? Got it there. You've already calculated it, but now you're just transferring into your deferred tax calculation. Okay, now what is your tax base? You have the cost is 30, right? You have the allowance. They are telling you, so if you go to your additional information, they are telling you that SARS, they're telling you here that SARS allows Section 11E on the straight line method over 6 years, and it is apportioned for part of the year, right? Now you do have what the cost is, right? Okay, so we've done it. Let me just open up this for you quickly. Okay, so you do, so there is your cost, and then now your depreciation or your tax allowance amount is going to be that amount. So what's happening is that it's 6 years, it's over 6 years, and therefore 100 divided by, so what I've done, I've translated this into percentage so that it's easy to calculate. So it's over 6 years, then you say 30,000 times divide by 6, and then you apportion for part of the year. Did I apportion that? I did not apportion in this case. But now you need to apportion this part here. It needs to be only for, no, it is for the full 12 months here because it was available for use on the 1st of January 2011. So you would have then have it available for use for the full year. Okay. I'm gonna answer that now. Yeah, so you would have that available for the full year. So now your tax base for the end of 31st December 2011 would have been 25,074. That would have been your tax base. Right. Now, and then your temporary difference would have been 2507, and then tax thereon is going to be 702. Is that a liability or is that an asset? Is the deferred tax that is recognized on the roasting machine a deferred tax asset or a deferred tax liability? It's a deferred tax liability. That's correct. Okay, why is it not now? Okay, anyways, fine. So this is supposed to be a deferred tax liability. There was a formula in here, but I'm not sure what happened to it now. Let's see quickly. Should be a formula, yeah. So it's a deferred tax liability. Fine. So now you are done with roasting machine. So you've addressed required 1 of the journals, you've addressed required 2 of PPE, you've addressed required 3 of your deferred tax calculation. We're going to do with deferred tax with or we can even do as well as in terms of your deferred tax note. There is your deferred tax balance for roasting machine. So this is how you get easy marks. You don't go all over the place. You do one item first, address all the required, and then you go to the next item to all the. That's how you're going to earn easy marks. Okay. So remember your forex gain or your forex loss. It has nothing to do with your PPE. It will be an item that would have been addressed in your so it impacts on your creditors. So it doesn't impact on your PPE, but on your creditors and the income statement. So it has nothing to do with your PPE note. Okay, fine. Now we're going to move on and now do the second part. The second part within the question it's regarding the processing plant. So now whatever that we did with the roasting machine, we will do the same with the processing machinery. We're going to take processing machinery, then run right through from the note to the deferred tax calculation and then to the deferred tax note. Right. So they say now here, you own a processing plant used for the roasting and grinding and packaging of coffee beans. The property was purchased on 30th of December. That's very important. For 3 million and land is R1 million, building is R2 million. Now, on the date, this was available for use and was also brought into use on the same date, that is the 31st of September 2011. Okay. Now, okay, and the residual value is 5 million allocated to building. The useful life is 25 years. Okay, and then we know that land was revaluated by the end of December 2011 to 1/250. Now, my advice to you is you start with land, and then you go to building. Because the reason why I'm saying that do them separately, the treatment for land and building for deferred tax purposes is different, because the manner of recovery as far as deferred tax calculation is concerned. So for deferred tax purposes, how are we going to recover the cost of the land? Is it through sale or is it going to be through use? It's going to be through sale, that's correct. And then in terms of the building, are we going to recover the cost of the building through sale or is going to be through use? It's going to be through use, that's correct. Fine. Now we know that when we sell something, there is CGT implications, right? Now, as we utilize something along its life, we will now be taxed or reap the benefits thereof as we use it. So the different tax rates or the different taxing techniques, they are different. So that will be recovered through sale. You have to account for CGT or take into account CGT implications. And then that will be recovered through use. You will then have to tax the normal way at 28%. So that's the reason I'm saying to you that you need to separate these two, right? Okay. Firstly, let's go. We've got easy information here. We've got cost. Now we know where we can use that cost. Let's go now to our PPE note. PPE note, we're now dealing with the processing plant. Now we're going to start with land. Land, we know that it cost us how much? R1 million, right? And obviously there were no depreciation, there was no accumulated depreciation or impairment loss. Therefore, the carrying amount at the end of December would have been R1 million, right? So we're trying to get easy marks here now without even having done calculations as yet. Okay, fine. Now, what we also do is we know that land, there's no depreciation. We did not acquire anything. However, we had, what did we have during the 31st of December 2011 for land? What was the transaction? There was a revaluation, yes, that's correct. How much did we revalue with? We revalued with 1,000, sorry, we revalued with 250. So now what the question is telling us is that at the end of 31st December 2011, your carrying amount or your value for land should be sitting at that amount. Okay, so now your carrying amount must be sitting at that amount. So it means we revalued land with 250,000. And then now thereafter we do our recon. There is the recon. So your recon must always balance to that amount. Okay. So you see you've got easy marks here by just copying and paste from the scenario. Okay. Now we've done the PPE node for the processing plant, but only the part for land, right? Now where do we go next? We go to the deferred tax calc, the easiest part. Right, fine. There we go. So processing plant, land. Do you now see why I'm saying to you that do them separately, even though it relates to processing plant, do land separately, do building separately. Because it's easy for you to get marks or accumulate marks. Because remember, this is the game. You accumulate marks, you pass. You waste time being all over the place, you're not going to make it. So use your time wisely and try and accumulate marks as quickly and as much as possible within the less space of time. Because remember, you've done your planning thoroughly. Now, I am never going back to the scenario. I've read the scenario once with comprehension, then I go and plot everywhere. So what is the carrying amount for land? It's going to be 1 million. Okay. What is the tax base for land? Tax base for land? There is no tax base for land. That's correct, Annelien. There is no tax base for land. And then what is then is going to be our temporary difference. Our temporary difference is going to be exempt. That's correct. Fine. Now, just because this part is exempt, it's not to say to you that don't show it. You need to show it, because for saying that it's exempt, you're actually accumulating marks. So yes, Varma, you're correct. The carrying amount is a million. So if something is exempt, you still need to tell the marker that something is exempt. Then you get your mark. But if you just leave it out, we don't know whether you understand the principle or you don't understand the principle, right? So that was 31st of December 2010. Now, in terms of now, December 11, what would have been the carrying amount? What would have been the carrying amount of the land? Okay, so the carrying amount of the land is I agree with both C. Baker and Annelien. So I agree, because I know from what perspective you both of you are answering from. So I agree with 1,250, and I agree with the 1 million, right? I agree with both of you. But from the answers that you've given me, how much is taxable and how much is not taxable? So how much is not taxable? That's, okay, Annelien, you're right. So it's okay. So my first question is, how much is taxable? Annelien, you're right. And then how much is not taxable? C. Baker, how much is not taxable? It's going to be R1 million. There we go. That's correct. Fine. So what I normally do is, because I've already indicated that that part is not taxable, then anything that is above cost, because remember, SARS doesn't know what a revaluation is. SARS doesn't have that. Okay, so now it says that when you dispose in this asset, you are actually going to pay tax on this one. Because remember, this would have been, so when you're doing your CGT, let me do this. So if you were doing your CGT calculation, you say your proceeds and then your base cost. Okay. So what would have been your base cost? Would your base cost have been 1,250 or would your base cost would have been R1 million? Your base cost would have been R1 million. There we go. That's correct, Sibeka. So there's a reason we're saying that part we actually do not tax it, because when you have to determine your CGT, when you sell that part will then be exempt, because it will be not exempt, but it will not be taxable, because that's the base cost. But anything that's above the base cost, which means starting from 1 million and R1, then it is taxable. So I hope you get the concept now as to the reason why that part is exempt. Okay, so the 250, you have to account for deferred tax in that. Okay, so it's 56,000. Is that a liability or is that an asset? It's a liability. Okay, fine. Now we are done with land for processing for processing plant, right? Now, what perhaps you would have done is that, we're done with land. Now we go to building, okay? Because remember, you've now addressed land here. You've also now addressed land in the deferred tax calculation. Perhaps you want to now go and then disclose it in your deferred tax note. You just copy and paste the amount. So whether the amount is right or wrong, the mere fact that you have transferred the correct the right amount into the right place, you will still get a mark because it's principal marks. Okay. So in terms of the building, you would have then done the same narrative. Okay, let's do the building quickly. Fine. Okay, so for the building now we go back to the scenario. We know the building cost as 2 million. We know that it's written off over 25 years, and then we know that the residual value is 5 million. We know that there was no revaluation. Okay, so the only extra thing now that will make us not come back to the scenario, we need to go and check how much is SARS allowing us for wear and tear allowance. Okay, SARS is allowing us 5%. That is not a portion. So even if you had it for a month, for 2 months, or 6 months, we're going to treat it as if it was for the full year. Okay. So I'm telling you now, after you've addressed the building, you will never have to go back to your scenario about this part again. You will move on to the next question. Okay. Now we're going to start with the PPE note. We know what the cost is. Okay. Yes, we had depreciation in during the current year. Okay. How did we calculate depreciation? Okay. Sorry, quickly. Just to do this quickly. Okay. Okay. So this part we've already addressed for land. Okay. Now we are in this part here. Okay. So now we know the cost is 2 million, right? And then our depreciation, we know that the useful life is 10 years. Sorry, is 25 years. We know that the residual value is 500,000. And then we know that we actually bought on the 31st of December, 31st of September. So September, October, November, December. So we only had it for 3 months in the current. We only had it for 3 months on the 31st of December 2010. Okay, so our depreciation is going to be 15,000. So we are portioning it only for 3 months out of the 12 months. Okay. So that will be your depreciation. So your carrying amount for 31st of December 2010 is going to be 1985. You go and transfer that amount there. You don't wait. You go and transfer, right? And then in the current year, you know in the current year that there were no acquisitions, there was no revaluation, because you understand what our scenario was saying. We know that there were no disposal, but what we know, there is depreciation in the current year. And that depreciation, we've already determined here. We've already determined here as to what the depreciation is 60,000. Your 2 million less 500,000 divided by 25 is going to give you 60. That's going to be your depreciation. You transfer it into your calculation. Then thereafter, you will have your carrying amount. That's your carrying amount. And then thereafter, we do our recon. And our recon must agree to our carrying amount. You're done with the processing plant now. You will never, ever, ever go back to your processing plant. You've done both in terms of the PPE, and now we go to deferred tax. We know that it cost us how much? 2 million, right? What is the tax base now? We know that SARS grant us 5% allowance, right? So 5% of 200,000, of 2 million, it gives you 100,000, and it is not apportioned. Even if you had it 1 month, you must treat it as if it's a full year. So your tax base for the 2010 financial year would have been 1.9. You transfer that amount. You transfer that amount into your tax base, which is 1.9, and then therefore you have a temporary difference of how much? 85,000, and then the deferred tax of 23,800. How much? Okay, sorry, is that a liability or is it an asset? It's a liability. That is correct. Yeah. So how did I get to the 15,000 of impairment? 15,000 is not impairment. 15,000 is depreciation. 15,000 is depreciation, is not impairment. 15,000 is depreciation. But in terms of the note, here you disclose both your accumulated depreciation and you disclose your accumulated impairment loss. We know that there was no impairment loss in the current year. There was only depreciation. Sorry, not in the current year, in the previous year. There was only depreciation. Right. Now in 2011, we're going to building. We know what the carrying amount is. We know what the tax base is. Okay, so the carrying amount for 2011, there it is. We've already determined that. Right? The tax base for 2011, there it is. We've already determined that. Right? So you just go and plot those figures straight into your tax calculation. Now you have a temporary difference here of 125, and then the deferred tax on that is 35,000. Is that an asset or is that a liability? It's a liability. That's correct. Okay. You're welcome, Andisiwe. So that's correct. Fine. Now you see, I am following the same approach. I'm starting with one part of PPE, do the note, do the deferred tax calculation, and then do my calculations. I plot all the figures where they belong. I go to my next. I'm going to go to my next part of PPE, do land in the note, do land in deferred tax, and then do land calculations and move on. And then go to the next one, do building in the note, do deferred tax in the note. And I'm telling you, even though you don't write 100% of your paper, by this method, I think you would have passed by now. Okay, but now this technique, it takes practice. You need to practice it well in advance before the exam, because when you get to the exams, you're not going to be able to obviously attempt this. So you practice. So the first step is read your question like you would read your newspaper. Fine, but now in that moment, what you need to be focusing on, what is the required part. That's very important, because your required part is then going to influence you as to what is the skeleton that you need to do. What are the skeletons that you need to do? What is the skeleton that you need to do? Okay. Once you have your skeleton, it's then easy to just go one item per item per item, and then just go and plot. You know, so it's going to be the same sequence over and over and over and over. And then where you see these easy marks, you would have been able to get all these easy marks here. That I can tell you. So all these easy marks here and all these easy marks here, you would have been able to get those easy marks, because we're working with principle when it gets to this stage, right? So the only part that I think you would have struggled with, which is I doubt you would, is only this part here. But this part, there is no, it wouldn't make sense as to why you actually can't gather those marks. It's very easy. It's very easy marks. Okay. But before I go to the office building, while at it, so while at it, I just need to address something. Right, fine. Now, if you were doing a proper PPE note, I would have wanted to see that. I would have wanted to see that this note that I'm preparing is for Choco Coffee Limited, and it's a note to the AFS for the 31st December 2011. And this note relates to property, plant, and equipment. Right. Okay, that's what you need to do. You need to tell the marker. So what the marker has asked you to do, you need to tell the marker that I am now responding to your required in terms of doing this. Because remember, the required said, let me go to the required quickly. So the required said you need to disclose the property, plant, and equipment note, and in the notes of the AFS of Choco Limited for 31st December. Now you need to tell the marker that I am doing the Choco Coffee Limited notes for the year ended 31st of December 2011, and now I am addressing the PPE note part. Then you're gonna go back thereafter, and okay, by the way, the deferred tax note was not a requirement, but I've just done it for you to show you how the deferred tax note look like. So it is not a requirement. The only requirement is the deferred tax calculation. But I think it's good for me to show you so that the next time around, if they ask the deferred tax note, then you know how to do the deferred tax note, right? Okay. So that's how I would want to do. Well, that's what I would want to see when I'm actually picking. So when the marker pick up your script, he needs or she needs to be able to see that, okay, this student is responding to this. This student is responding to this. The same as your journal entries. Your journal entries must tell us as to what it is that you are doing here. I am doing the journal entries. The 1st of December is the year end for okay, the question was Montana here, so you can say yeah for Choco Coffee Limited. That's what the marker should see. Okay, right, now where's my question now? Okay, so now the other part is which is I think I did it differently in terms of in terms of my solution, but it's not a train smash. But in terms of you in the solution, you will need to do it separately. Okay. Now, this part of the section, what topic is it dealing with here? Or in terms of which standard are we dealing with here? Are we dealing with IAS 16 or are we dealing with IAS 14? Okay, here we are dealing with IAS 40, which is investment property. And the reason why I'm saying to you, or the reason I'm asking you which standard I'm dealing with, because this specific part here, it needs to be dealt with in accordance to IAS 14, right? Okay. So in terms of the disclosure of the amount, whether there is cost, revaluation, that and that and that and that, for deferred tax purposes, it will still be the same. Everything will still be the same, but it's just that the structure of the note that will be different, you know. But it's basically the same thing. Now, with investment property, then it becomes a little bit tricky when it comes to deferred tax. Because, or if I may ask you, now, if you need to go to deferred tax calculation for your investment property, for both for land, and both for buildings. How would you expect to recover the cost of the land as well as the cost of the building? Would you expect it to recover it through use, or would you expect it to recover it through sale? Both the cost of the land as well as the cost of the building. How do you expect, or what is the manner of recovery or of the cost for those two? Is it through use, or is it through sale? Okay, so I am not going to give you the answer for that. Okay, but now what I suggest that you go and do is that I have loaded on the drive a document that deals in terms of the investment property, right? Okay, so this document here is a decision tree that then makes you decide whether am I dealing with IAS 40 requirements here, or is it not IAS 40? Okay, whether am I dealing with IAS 40 requirements, or am I dealing with requirements relating to other standards? Okay. So when you're dealing with that question, the first point of departure is the property held for sale in the ordinary course of business? Yes or no? So for instance, if I hold a property for sale in the ordinary course of business, that will be my trading stock. But then in this case, the office building is not trading stock. Right? So we're saying no, it's not held for sale in the ordinary course of business. Fine. Now, is the property owner occupied? So I now, as Choco Coffee Limited, am I occupying the building? So as Choco Coffee Limited, am I occupying the building? No, I am not occupying the building, because it's saying the building is leased out to Reed First Limited for their administrative purposes. So we're renting the property out. That's correct. That's correct, Judy. So we do not occupy the property. Fine. So now we go on to the next step. Is the property being constructed or developed for future use as investment property? Yes, it is used for future investment property. That's the use understood. That's correct. Yes. Okay. And then we classify the property as investment property. Okay. Then you either then choose whether you will use either the cost model or the fair value model, but the question is going to tell you which model they have adopted in that regard. Okay. Now, let's go back quickly, right? Let's go back right quickly in the beginning. So if you said that it was held in the sale of an ordinary business, then you would have used IAS 2, that's inventory, right? And then if you say the property is owner occupied, you would have used which standard? IAS 16, that is your PPE. Okay. So this is a summarized version of what IAS 40 is saying, but it's not all that's covered. There's more that's covered. But for you to get a quicker understanding, that's what you need to do. Just to pack this one a bit quickly, if you can do me a favor, after the session, there is evaluation forms that is available online, and Claudine has posted us in terms of where can you find that. So where all the files are sitting, I think it's tab number 3 where it says feedback form. So if you can just complete that for me at the end of the session, I'll actually appreciate that. Yeah, fine. Now let's move on to the next one. The next one is okay, I've done investment property. Okay, so I think it's also worthwhile for you just to read through in terms of the manner of recovery for different classes of asset. So here it gives you an example as in terms of if land is revalued, what are you going to do? And then it also speaks here about in terms of the recovery of revalued non-depreciable assets. So non-depreciable assets relates to land. Land is a non-depreciable asset. Okay, so IAS 51, it requires that the deferred tax liabilities asset should reflect the tax consequences that would flow from the manner in which the entity expects at the end of the reporting period to recover or settle the carrying amount of those assets or liability which give rise to deficits. So in summary, it says, how do you expect to recover the cost of that asset? Is it through use? What's the tax rate applicable? Or is it through sale? What's the tax rate that's applicable? So that's what that standard is actually saying. Okay. Now, when we're dealing with non-depreciable asset, which now we're dealing with land. So land will then fall into this schematic presentation or diagram to say, if I now have a non-depreciable asset, okay, so the same would apply for investment property, because investment property is non-depreciable, it's not depreciated. Okay, so the same as land is not depreciable. Okay, so non-depreciable asset, we're saying here is only land, but also not land only, but also your IP, with your IS40. Okay, now the manner of recovery will be through sale, right? And then therefore you need to provide depreciation at the CGT rate, but only on the amount above the cost, not from 0 to 1 million, as the example we had earlier, but from 1 million, R1 up until 1 to 50. So only the 250,000 that you're going to tax at 80% by 28%. Okay, so the same thing that then you would do for an investment property. Okay, so for investment property, there's two legs, and within these two legs, I don't support, or let me not say I don't support this part, this side here. Okay, because to me it doesn't make sense that your investment property, the cost thereof, you'll only realize it through sale when you actually sell the property, right? So it doesn't make sense that you provide for deferred tax at 28%, because you only expect to recover the cost of that through sale. So it only makes sense that you provide for deferred tax at the CGT rate, because you are not using that property, but it's only for rental purposes. That's where you derive your income. So this is the part that I support more. I support mostly. But if you have a valid argument in your solution when you're attempting the exam for this part, then I think you can raise that. But my argument is I am in preference of this method. Okay, but obviously depending what the scenario is giving you. But in this case, I would have chose this part here and not this one. Okay, so I think that's all that I wanted to address as far as investment property is concerned. Okay, now let's go back to our original question. Okay, so now we know that we deal for office block, we're dealing with investment property. We know what the cost is. So are we going to depreciate this property for the 2011 financial year? Yes or no? Are we going to provide for depreciation on the office block? Yes or no? Okay, so there is no depreciation that we're going to provide. No depreciation that's going to be provided on the office block. Okay, so C. Baker and Ostacia, there won't be depreciation that we provide on the office block, because even the first instance is that we are not even given a depreciation rate. Okay, so in terms of the standard, there won't be depreciation provided for investment property. Okay, that's the requirement of the standard. Never forget that there is no depreciation that's going to be provided in this regard. Okay, now I'll just take one of these two. I'm gonna take I'm gonna take the building, and then just do, before I conclude, and then just do the note, the deferred tax calc, and then we know that to conclude for the section, Okay. Now, if you take the building, right, Okay. For the building, what would have been your carrying amount for 2010 for building? Okay, you would have obviously there wouldn't be a why do I have zero here as the carrying amount? Okay, so the reason why. Okay, so what I suggest is okay, so you either put in zero or something or whatever you could do it, and then put do I say exempt here or what? What am I doing now? Yeah, and then obviously you will still have the carrying amount irrespective of what the amount is. For, let me just check quickly. Okay, so your carrying amount at the end of this period would have been zero. Okay, that's the reason why I put in zero there. So, okay, let me just. So your carrying amount would have been zero because it was only bought in the current year, and then the same is the tax base. But now, what would have been your carrying amount in the current year? Carrying amount for building in the current year. So your carrying amount for building in the current year would have been 1,350. Yes, that's correct. Would have been 1,350. That would be your carrying amount. Okay. But now what I do is I split the, just not to get confused, I split the two between the cost and the revaluation so that I know how I'm going to treat this. Because the moment I combine the two, then it's going to be difficult for me to say, how do I treat this one? How do I treat the other one? So what I do is I'm going to say, because of its investment property and the position that I've taken on investment property, it's this side here, right? So anything that is below cost, so anything from zero to up to cost, I am not going to tax it. But everything that is above cost, which is from 1 million rand and 1 rand, I am going to tax it. So there it is. So zero to cost is then exempt. You need to show it that it is exempt because you get marks from that. And anything that's above cost, you then need to show that I am going to recover the tax or I am going to pay tax in future at 80% because that's the CGT. Remember what I said to you is when you're determining your CGT for building, you're going to say what your proceeds are, let's assume is 2 million rand, right? And then the base cost, you would have been able to deduct the full amount, so it is not taxable. And then you will be left with whatever amount that you're left with that is going to be taxable. So this is the principle here. That's the reason why we're saying that it's exempt, because you can deduct the base cost in terms of CGT requirements. Okay. And then I think that's about it. So for tax, there is nothing for tax then except in your deferred tax calculation. And then I think that's about it. And then for your disclosure in your deferred tax note, if they ask you to do one, those would be the amounts that you will have to go and disclose. Let me open this one as well. Okay. Okay. So there is land. Everything. So anything between zero to the cost is exempt, and then anything that's above cost is now taxable at the CGT rate, because you'll expect to pay when you actually sell the asset. Okay, right. So what's also important here is in terms of you need to indicate whether something is an asset or liability. This is not right. So you need to indicate whether something is an asset or a liability. Okay. And that's about it. And then you would perhaps then do the same in this regard. But obviously this would then this would be a note under investment property. Investment property. But in terms of your module, just do this separately. You need to do this separate because this would have been then in accordance to IAS 40, and then this would have been in accordance with IAS 16. So you need to do them separately. I've done them together for the purpose of this this exercise because I didn't want to move in between the sheets. So I suggest that you do them separately. Okay, so what I will do subsequent to the session is, because I see we only have 15 minutes left. So subsequent to the session, what I'll do is I'm going to go and load. I'm going to go and load this. I'm going to go and load this solution on there. I'm not sure how you guys are going to write, whether it's online, sorry, not online, whether it's going to be e-writing or it's going to be handwriting and then you post your solution or however that you want to do. But I suggest in this period, I think you guys need to practice actually both ways. So you do one exercise. So you do one exercise through your normal writing and then try and do a photo or a scan and then see if you can upload onto whether your desktop or try perhaps on an email and so forth just to see everything is working. But also try and see if you can perhaps do this in a Word format or you can do it in Excel that you can then thereafter convert it into a PDF. But make sure that all your calculations are being shown. Okay, because I don't know what the stance or the take is going to be in terms of you guys writing online, because I think at this point in time, physical based writing is not possible. So I think in between, just try and practice that, because you will not be able to practice this on the day of the exam. The 3 hours might seem it's a lot, but tell me it's not a lot, especially now that you're not going to be able to have a printed copy. So everything now is on your PC, and perhaps you only have one PC. You only have one PC, unlike I have two screens here, so it's easy to move in between documents. I suggest that you practice now, train yourself, and then when you get ready, when you get to the exam, then you are prepared in that regard. Okay, so if there are no other questions, or let me conclude here. But if you have questions, I am going to stay for I'm going to stay here for, let's say, another 5 minutes. So what I'll do is I'll make these items available. So it is already available, but some of them I was typing as I was speaking to you. So I will make them available, or I'll load them again on the drive. So have a look out for that. And also in terms of the next reading or the next prep that you need to do, I will also load it on the same drive over the weekend for you to be able to access. So what I would advise you to do is go through it, read it, attempt it as far as possible. If you get so you will attempt it under normal exam conditions. Let's say if it's for 2 hours, it's for 3 hours, do it for 3 hours. So once the time expires and you are not finished writing, what you do is that you then take a red, pink, green, purple pen, then you continue writing, because what you're trying to do, you're trying to see how much marks you would have lost if it was the normal exam, and then thereafter you then need to decide whether you want to, must you now increase your writing speed, or must you increase now your reading speed, or what it is that you need to do. Understand? So those are some of the exam techniques that you need to do. And I've been saying to people that most people do not pass this module because of the clever. We pass this module because we have a very good exam technique, and that's the game changer. If you have a good exam technique and you've got the basic principle, there's nothing that stops you from graduating from this module. Okay. So let me conclude in this. So please do me a favor, complete the self-evaluation form. It's not self, complete the feedback evaluation form. It's on the same tab as the session, but I think it's titled feedback. Please complete it for me, and then Claudine then will have a look at it to see perhaps if there's anything that you guys want us to improve on, or me or the facilities team in that regard, whatever. So if you have questions, I'll still be here for the next 5 minutes. And then I think then I'm concluding this session. Thank you for participating, and I hope to see you next time. I'm off. Okay, so I'll wait if there are questions, and then if not, then I'll leave in the next 5 minutes. Okay, I think that's about it. Cheers, guys. Okay, I just need to save that.